Thank you, and thank you so much for being here. I appreciate it. As a business owner, small business owner myself, access to capital is extremely important to me. So I want to talk a little bit about the Fed's balance sheet and just get a better understanding of how we're thinking about it. I mean, some experts say that the Fed's balance sheet or large balance sheet is distorting the markets and keeping long-term rates, let's say, too low. Also, I think it limits the access to capital, right? Historically, if I'm accurate, the balance sheet's been about $4 trillion prior to the pandemic. Then we raised it, almost doubled it to about $9 trillion, and now it's on a kind of a downward trajectory to about 7.2. Again, if my math is right. Do you think we're on the right track in shrinking this balance sheet?
I do, yes.
I'm trying to get a sense of what the landing spot, in your opinion, should be. Do you think we'll get back to the $4 trillion?
No. So we're in what we call an ample reserves regime. And what that means is that the quantity of reserves, demand fluctuates, and this means the quantity of reserves can fluctuate without affecting interest rates. And we think that's a good thing. What that means is there's going to be a lot of liquidity in the banks and in the financial system. That's a good thing. There wasn't enough liquidity before the global financial crisis. That was one of the problems. We have some shrinking left to do on the balance sheet, but we're not going to get down as far as you asked.
Where do you think we'll land? Because let me start. I'm sorry. Where do you think we'll land?
You know, I can't give you an exact number, but we're going at a pretty modest pace now. We've slowed down, kind of cut in half twice the speed. We think we can go for a good while at this speed, and we'll learn as we go.
So you think the trajectory, so to speak, will remain?
Yes, and I think the fact that it's quite a gradual trajectory now is going to enable us to find that level that is ample and not scarce. When reserves are scarce, you get a lot of volatility, and that doesn't help. So I think that's a good framework. The ample reserves framework, I think, serves the country well.
And you're not concerned in terms of the access to capital? I mean, as a business owner, that's what I look at is I got to be able to get capital, and some people are saying, we're really hanging on to our cash.
I think honestly, I think if you took the trouble to go back to a much smaller balance sheet, it would have no effect whatsoever on capitalability for companies. You wouldn't do that at all. We're not pulling capital away from companies. That's not what's happening. It's just you have a big balance sheet where there's a lot of liquidity. The result is there's a lot of liquidity. Banks are flush with liquidity for the most part, and that actually enables lending. It probably wouldn't have much of an effect one way or the other if you went back to a smaller balance sheet.
So you're comfortable with the liquidity. You're comfortable with the access to capital. Excuse me.
I mean, we look at credit availability for smaller businesses, and right now conditions are a little bit tight.
Yeah, it's tough for people in my district.
I would say that they're not terribly tight, but we do see that there's some tightness. But that's not really a function of the Fed's size of the Fed's balance sheet. That's just that banks are perhaps a little risk averse in this uncertain environment.
I think it all marriage goes together and is kind of intertwined. But I appreciate that. I want to just switch gears a little bit. Are you seeing any signs of financial instability building beneath the surface that we may not be seeing maybe on top of the surface, whether it's in commercial real estate, private credit, regional banking, anything you're seeing underneath the surface that could derail the growth path?
Not really, no. I mean, you mentioned there are a lot of pots that we need to watch to see that they don't boil over. CRE, it's been a problem for 5 years. We're working our way through it. I think we're making good progress there. It's not getting worse. It's getting a little better. Private credit is, has its real positive attributes. A lot of it's not funded by deposits, so it's not. As long as it's not funded by retail or by deposits, it's actually fine for financial stability, but it's a very big and fast-growing sector, and it hasn't been through a real downturn, and it's quite diverse, so I think it bears close watching. I mean, asset prices are high, but leverage is not particularly high for corporations and households historically. It's not particularly high for banks. Banks are well capitalized, so I think overall financial stability conditions are not in a place where we worry a lot.
So we're really poised in a pretty good position economically.
Gentlelady's
I
time
think
has
so, yes.
expired.
Thank
Absolutely.
you, Mr. Chair. Thank you.
Absolutely. The chair now recognizes the gentleman